Welcome to the Boomers, Bucks, and Bling podcast, where we turn retirement planning into a bit of a thrill ride. I'm your host, Carl Spiteri, and each week we'll dive into everything from reverse mortgages and staying put in style to Medicare, Social Security, and home safety. But wait, there's more. We're not just going to talk all about money and business. We're going to add some sparkle, some bling, as we chat with travel pros, party planners, and a lot of different topics that's going to help you make the most of your golden years. So grab a cup of tea or whatever it is you want to drink, get comfy, and let's make retirement planning an adventure of a lifetime.
Hi, welcome to Boomers, Bucks, and Bling. My name is Carl Spiteri, and I have my special guest, Steve Alpinieri, here today, who's a CPA and is going to maybe talk to us a little bit about challenges that boomers may have with taxes and Social Security, that kind of stuff. Welcome, Steve.
Hi.
Hey, why don't we jump right in? Why don't you tell us a little bit about you and your practice? You know, how long you've been in business, what you do, how you do it.
Yeah, great. Thanks for inviting me to today, Carl. I'm a CPA, local CPA here in downtown La Jolla. I've been in practice, practicing CPA for over 25 years, 14 years under my own firm. Currently, I have a quality staff of tax assurance services, and various bookkeeping, and basically offering full service CPA services for all needs of the public, specializing in industries of construction accounting, real estate, professional services, and some trusts and estate work. I've been doing this for a long time, and I'm glad to be here today.
Well, good. I'm glad you could join us. Thank you for making the time. I know it's very, very valuable time, even though it's, quote, not tax season. Tax season is almost a 12-month season anymore, isn't it?
Exactly.
Hey, so we're here talking to retirees, right? Baby boomers. 10,000 baby boomers are retiring per day from now, for a long time from now. And what are maybe some tax tips to give to the boomer generation that you could think of?
Well, number one, I would say, is make sure you have a family trust set up. Your last name, like Alpinieri Family Trust, Spiteri Family Trust, and what that really that helps in a variety of ways. One is helping you avoid probate, and I've never heard anything good about probate, so
What
I
is
won't
probate, Steve?
excuse me?
Explain what probate is.
Probate is what the state of California has set up as a default in case you do not set up a family trust. They have an expensive process called probate, which helps in the event of your passing, transfers your wealth to the next generation according to some specific rules that the state legislators have come up and decided. The family trust, however, is the alternative to avoiding probate, because that allows you to make your wishes known. And if your assets are properly placed into a family trust, they can avoid probate.
Which is very expensive.
That can impact taxes dramatically. There's a lot of estate planning changes coming down the pipeline with the pending upcoming elections in the United States here in November. There's the Trump Tax Reform Act that he put in place in 2018 are coming to an expiration date unless extended by the government. Currently, the estate exemption from estate taxes is $13.61 million per person, or 27 million and change for a married couple. After 2026, that exemption drops down to a projected $7 million or $14 million per couple which being California has a lot of high net worth individuals, that could dramatically impact your taxes because the amount in excess of that is taxed at 40%, which is
Okay.
a huge number.
Yeah, and with the price of real estate in California, 7 million may seem like a lot of money, but it could be 2 or 3 pieces of property, right?
Correct. And as well as one of the other pieces that some people don't fail to factor in is life insurance. It depends on how you purchase your life insurance policy, but your life insurance policy, if it's placed into what's called an ILIT or an irrevocable life insurance trust, that could avoid those proceeds being clawed into your estate, causing your estate to potentially exceed those thresholds that I mentioned earlier. So, but there are some potential drawbacks. So an ILIT could be an alternative to save you some enormous taxes, as well as there are several other animals to do some estate planning, such as discounting properties, family trusts, family limited partnerships, and stuff that I don't want to get too deep into it
Yeah,
in
yeah.
this today, but definitely I could working with our firm, you could definitely help. We could help you save an enormous amount of taxes for you know, the high net worth individuals.
Hmm. Okay. So that's for the clients with substantial assets. So let's bring it down a little bit to people that don't have $7 million worth of assets, right? So a lot of times when I'm speaking to clients and individuals, they're talking about downsizing. So I know there's exemptions from capital gains and things like that for your primary residence. Can you get into that a little bit?
Right, definitely. This happens to impact most people who own their primary residence, and currently the law is set up so if you occupy a piece of property for 2 out of the last 5 years, the government allows you to get either a $250,000 exclusion from capital gains or a $500,000 exclusion from capital gains in the event you're married and filing jointly. The exclusion is an enormous benefit because it's not only is it a federal tax benefit of exclusion, it also, on a rare occasion, it also excludes from California taxes as well. California is one of these states, as most people know, is very hard to do tax planning because there's not a lot of allowable deductions. This is one of the deductions that's available to people, and they definitely should take advantage of that deduction under code section 121 for the code jockeys out there.
So it's a $250,000 if you're single. It's $500,000 if you're married, and the fact that you were once married still doesn't matter, correct? Just to clarify, if you
Yeah,
were
there
married and
are
a
some.
spouse passed away or something like that.
Well, in the event of that's a very good point. In the event of going back to, in the event of you're married, your spouse passes away, a lot of times going back to the family trust model, usually the family trust is set up such that you allocate, you know, assuming everything in the estate is considered community property, because most assets acquired in California are considered community property, unless there's certain exemptions to that, such as owning it prior to marriage or inheriting it post-marriage. But generally speaking, all assets that you earn during marriage are community assets. Those assets then would get allocated between the A trust and the B trust. The lawyers of the world like to use a lot of different terminology for A trust, B trust. The B trust is commonly referred to as the bypass trust or the decedent's trust. It is the spouse who's passed share of the estate. What the goal being, you want to fund that decedent's trust such that bypass trust, decedent's trust now will never be subject to estate taxes in the future. That will pass to your next generation estate tax free. However, during your life during the survivor's life, usually what's set up is the decedent trust pays the residuary or the survivor's trust a quarterly or an annual income for that surviving spouse to live on for the rest of their life. And what that does, it's very important from a tax point of view, because that payment from the decedent's trust to the survivor's trust is a deduction from the decedent's trust and income to the survivor's trust. This probably gets a lot of people's heads spinning because of a lot of the terms, but generally speaking, with the family trust, you want to have these assets segregated generally with the advice of professionals to make sure that there's various pros and cons of putting different things in different trusts and making sure that the best tax treatment for your situation applies. One to go down to one area that's most commonly I come across as errors in the estate and trust world is a lot of clients lose their spouse or lose a family member, and what they do is they fail to get what's called a step up in basis. And Carl, I'm sure you know what the step up in basis is.
Why don't you define that? Because that's important.
Yeah, when community property, when one spouse passes in its community asset, you would typically get an appraisal. And so let's say you bought a property back in 1980 for $100,000. Today, that same property might be worth $2 million. But because you bought it back in 1980, it's virtually fully depreciated with the exception of maybe the land value. So then the spouse passes in 2024, that we go out and order a formal appraisal of that property, determined by qualified appraisal or alternative methods, which we can get into as the client's or taxpayer situation deems necessary. But we get an appraisal and we effectively reset the depreciation table as if you had purchased the property for $2 million. Now you get to redepreciate that same property, assuming it's a rental property, either commercial or residential, over either 39 years or 27 and a half years. So in the case of commercial, that's approximately 2.5% per year. So now on that $2 million property, assuming the $2 million was allocated to building, you would get approximately $50,000 a year of depreciation for the next 39 years, effectively wiping out, assuming the person's in a 40-50% tax bracket, it'd save them $25,000 a year for the rest of their life, or effective life for 40 more years. So the step up is an enormous benefit, and I see this quite frequently that the do-it-yourselfers out there fail to catch the step up, and that step up not only saves you immediate tax dollars, but as I explained, it can save you tax dollars to 27 and a half or 39 years into the future.
Wow, pretty incredible. Sticking with taxes for a minute, what do you know about property taxes and the exemption to Prop 13 for seniors? Could you go into that a little bit?
The property tax exemption basically it works the way that you can in California, that you're locked into a 2% per year increase over your purchase price every year. When you hit, now they've come up, one of the several years ago, they came up with Prop 19. Prop 19 severely limited the ability of some taxpayers to take advantage of keeping the low property tax basis, but it also allowed for some additional benefits. One of the benefits, or a lot of the problems with Prop 19 is that prior to Prop 19, you could transfer any property to your heirs and they could file for a parent-child exclusion. So let's say the parent owned multiple rental properties. The parents decide, oh, to the adult children, I'm going to transfer one of my rental properties to my child. They're going to now occupy that property as a primary residence, and they're going to get the benefit of the parent-child exclusion from Prop 13, keeping their property tax basis very low, back to the approximately 1.1% of the purchase price plus 2% escalation every year since the parents have owned that property. What happened under Prop 19, however, is now the parents cannot transfer their rental property to the child and avoid the step up in the property tax basis. So what that means is, let's say you bought this rental property for the $100,000, it's now worth $2 million. The county, when you transfer the rental property to your child, the county will come out and reassess the property based on based on their assessment. The good news is, if you don't agree with their assessment, you can appeal it. The bad news is it's going to be reassessed up to, in that example, it would be a $25,000 a year property tax bill that may have been historically in a $5,000 a year property tax bill. So now your property tax bill quadrupled or more because you transferred it. The one exception that now the county allows you to do, however, is if the parents own their property, they have the option to transfer their primary residence to the child and still allow for up to a $1 million property tax exemption. But the child still has to occupy that property as their primary residence. The moment the child decides to move out of that property and say, oh, I decided I'm going to live at mom and dad's house for a year, and then I turn it into a rental, now the county is going to reassess it back to fair market value under Prop 19. So it's going to, unfortunately, you're going to lose the benefit of the parent-child exemption the moment the child moves out. So that's one of the negative impacts of transferring your house or your property to your child.
Wow. So what you're telling us here in the minutes we've been speaking is that even getting older is complicated.
Exactly. There's no escaping extra taxes, unfortunately,
It
but we
doesn't
do
seem
our
like it,
best
my
to
goodness.
find as many areas where we can do tax planning to minimize the damage and to keep your hard-earned money back in your pocket.
Would you say that's what makes you special in your business?
Definitely, definitely. I really try to, I try to, or I interpret the laws and apply the laws to the best ability to give my clients the best tax treatment. I always take it to the level of, I don't, if I have some medical issue, I go to my doctor. If I need a mortgage, I go to Carl. I don't try to do it myself and go online and say, hey, I'm going to self-diagnose or I'm going to find my own mortgage. I always go to a professional. I always, same thing. If I ever needed a lawyer, I would hire a lawyer. I wouldn't go ahead and hire and try to do my own law myself. So I always say accounting. It's there are some areas that people can do themselves, but a lot of times hiring a professional, I always try to I bring the value to the clients by my 25 plus years of accounting experience and doing this on a daily basis versus and let the clients do what the clients do on a daily basis, because I'm sure that they're making their net worth doing what they do best, and I just try to make sure they keep what they earn as much in their pocket as possible.
Great. Well, Steve, how do people get in touch with you if they want?
My email address is steve@sandiegocpasteve.com, or my telephone number is 858-230-6610. I'm at extension 101, and I have an assistant, Hunter. He's on the phone tree, and if I'm not available, feel free to select Hunter on my phone tree, and he will be able to schedule an appointment, and I'd love to meet you.
Great. Well, Steve, thank you very much for your time. We truly appreciate it. Maybe we'll have you on. I can convince you to come on again sometime. We'll cover a few more things. But thank you for joining us for this episode of Boomers, Bucks, and Bling, and we'll talk to you next time. Thank you.
Thank you.
The content of this podcast is intended for informational purposes only. It does not constitute financial, legal, or professional advice. You should not rely solely on the information presented here to make any decisions. We recommend seeking the guidance of a qualified professional for any specific situation. Arc Latex Financial Services, LLC, NMLS number 2143. Its hosts and guests cannot be held liable for any losses, damages, or other negative consequences arising from your use of the information presented in this podcast. For license information, visit www.nmlsconsumeraccess.org. Equal housing opportunity.